Hi, I'm James Robinson, and this is my stock pick of the week. In today's video, we're going to combine what is usually two different videos. We're going to combine balance sheet and dividends. We're going to do that because there's not much to talk about on balance sheet since the company has virtually no debt. We're going to combine those two videos into one today. So when I'm looking at the balance sheet, what I am trying to do is figure out the risks that this company has that it will go out of business. I don't really look at the balance sheet as a way to measure whether the company's going to make money. I look at it to see what's the book value in case we can really buy a fantastic company at its actual price. But more importantly, I'm looking at it to see what are the chances something's going to go catastrophically wrong and we're going to lose our investment. So the first place I look to do that is cash and marketable securities. Cash is king. Cash gets you out of a lot of trouble. I like companies that have a lot of cash, especially cash relative to their operating costs. So you can see that here, this company has had varying amounts of cash and reserves over time. Really kind of the modern era for this company started about 2010. The company bottomed out in terms of its cash in 2011 and has been gradually, the cash on market series has been gradually rising since then. They don't have a surplus of cash on hand. The company seems to be very, very lean. They have, we're going to see in a few minutes, barely enough cash on hand to cover their current obligations. However, they do have enough cash and it is gradually rising. So there's nothing to be concerned about here. Also, they're not hoarding cash, which means that they're doing the best they can to return money to us, the shareholders, which is something that I really like. Also, you can see this gradual increase for a period of 6 or 7 years shows the company has a pretty good handle on their finances. This is really the same chart, but I've added in investments and advances. The company has a significant amount of that. And so you can see the total reserves, which are cash equivalents, marketable securities, as well as investments and advances. So you add that all up and you come with a number that's just north of just about $100 million in cash on hand. And that's for a company with a market cap of $250 million and very little debt. One of the things that we're looking for when we look at a company is companies that will be able to endure bad times. Obviously, COVID is an example of what can be really bad times. There's a number of things that can do that. A recession, something happening with your business, particularly you lose a division or you've got, you lose a major client, whatever it might be. The fact is we like to be in a situation where we have the cash on hand to pay our bills in those extraordinary circumstances. This company is run extremely lean. They have oftentimes over the last 10 years had less money in current assets than they do in current liabilities. To refresh your memory, current assets are money that you either have or will have within the next 12 months, and current liabilities is money that you either do or will owe in the next 12 months. So oftentimes people like to see those ratios be equal. They like to see at least as much assets as you have in liabilities. It's not necessarily required. If you've got an extremely steady income stream and you're very comfortable what you're going to make over the next 12 months, you don't need to have a year in the bank because you know that you've got this income stream coming in. I still like to see it though. I like to see more than a year's worth of current assets for relative to current liabilities. And the good news is this company in the last 3 years has gotten to that point. They've gradually increased their reserves. Their costs have been relatively constant. And as a result, they, for the last 3 years, have actually reached that threshold, which gives me a level of comfort. Before we go any further, if you watch my videos, you know that I take great pleasure in having new followers from around the world following me. If you're following me and you like these videos, just drop me a note in the comments that says, hey, I'm from Chicago or I'm from Berlin, and I'll put a dot on the map for you. I'd appreciate it. Also, if you want real-time information when I buy and sell stocks and updates on when I post videos and other thoughts I have on the market, you can find that on Twitter. My Twitter handle is @RobinsonStocks. I'd love it if you'd subscribe or like these videos as well. There's a number of reasons why I don't like companies to have debt, but the biggest single reason is interest payments. Interest payments are one of those operating taxes. It's a self-inflicted operating tax that oftentimes you don't have to have, but companies have it anyways. But it's one of those things that you can't get out of and you can't downsize in bad times. They just sit there and siphon cash away from your operations. So I look very closely at a company's interest obligations and interest payment obligations. With this company, and one of the reasons I'm not spending a lot of time on the balance sheet for this stock is that they have no debt and thus they have no interest payments. So there's not much to talk about with these slides. There are two kinds of debt that a company can have. Current liabilities we've talked about is money that you owe in the next 12 months, and long-term debt is money that you owe for some period of time in the future longer than 12 months. Here you can see the current liabilities for this company are basically flat for the last 15 years, so no problem. And you can see that the total long-term debt has been zero for a long time. Just at the end of 2019, they took on about $10 million in debt. We'll see what they do with that, but it's not significant relative to the cash on hand, which is north of $100 million, or to the interest payment issues. So long story short, I'm not worried about that $10 million. I think it's a short-term thing. But again, so the debt analysis for this company shows there's nothing to be concerned about. Also, interest coverage ratio, there's no interest to be paid, therefore there is no issue with interest coverage ratio. One of the things that I look at with a company is how long would it take them to pay off their debt if they decided to make that a priority. And I like to see no more than 10 years, and ideal I like to see less than 3 years. Here you can see this company could pay it off in less than a year, so the debt is no issue as it relates to earnings. Now we're going to start talking about dividends, which is a little more interesting for this company. Here you see the dividends that are being paid by the company in terms of total dollars. And a couple of things to keep in mind here. In 2004, they obviously paid a special dividend that was pretty significant. Sort of ignore that. That's 15 years ago and doesn't have any real impact on this business. In 2009, they paid a kind of outsized dividend. But since then, in 2011, the dividends have been basically flat. They've gone up a little bit. The thing to keep in mind here is that the dividends have been increasing. They've been increasing marginally, but they have been increasing every year. Also, the slide on the left, the chart on the left is total dollars paid in dividends. The more important thing is dividends paid per share. And you can see that really since 2014, the dividends paid per share have gone from, I don't know, call it 50 cents a foot to call it 85 cents a foot. I don't know exactly what they are, but in that range, and they've gone up every year. So we're getting a nice increase in our dividends. You're going to see in a minute those dividends have gone up about 6% over the last 5 years. For me, when I'm looking at a company for its dividends, and dividends oftentimes is a reason I will buy or not buy a company, but I like to be sure not only what the dividends are, which we covered on the last slide, I like to know how safe they are. And to determine that, I look at 4 factors. One is the yield and growth. So what exactly is the dividend that's coming in and how quickly is it going up? What is the dividend safety in the context of earnings? What is the dividend safety in the context of cash flow, which is oftentimes more illustrative of what's really happening? And what is the dividend safety in the context of its current debt load? So we're going to go through those now. So the current yield is 3.11. Actually, that was the yield as of the day I did this video, or the day I suggested you buy the stock. It's actually gone up to about 3.26 today. The stock's gone down a little bit since I bought it. But the average for the S&P 500 is 1.73%, so it's just under twice what the S&P 500 pays for the average dividend. That's fantastic. The dividend growth has averaged 6.2% in the last 5 years, so it's outpacing inflation significantly. So if you had bought this stock, and if you bought this stock as part of your retirement portfolio, even relative to inflation, you'd have a nice raise every year in your quality of life. So those are important things to keep in mind. You can see that the blue line is the dividends per share. The red bars are the amount of increase, and you can see that increase is coming down gradually, but it's still north of 5%. This slide looks at dividend safety in the context of earnings, and the way we measure that is what percentage of the earnings are being paid out in dividends. The higher that portion is, the more risky the company is, the more risk that the company will not be able to sustain earnings to pay out that amount. Obviously, if a company is paying 10% of its earnings out in dividends, they could have a 90% reduction in earnings and still have enough money to pay the dividend. Conversely, if the company is paying 90% of its earnings out in dividends and they had a 15% reduction in earnings, they'd have to cut their dividend. And we know that when companies cut their dividend, the stock price tends to drop disproportionately. And so we don't like companies that reduce their dividend. We prefer companies that will raise their dividend. So what we're looking at here is the current payout ratio. For this company, it's 50%, which is great, not fantastic, but also not scary. The average payout ratio of the S&P 500 is 40%, so we're sort of in the safe range. The average payout ratio for the last 5 years has been 63.2%, and that's actually it's actually a bit misleading. They had a couple of years where they really paid a lot, but for the last 3 years, been pretty conservative in the dividend payout ratio, and so we're pretty comfortable with that. And so I see no real reason for concern with a 50% payout ratio that this company can't continue to pay their dividends, even as we fight through COVID. And to be fair, I'm giving every company a pass on the fact that they might be reducing their dividend during COVID and sort of assuming that as we come out the other side, it'll normalize and go back to normal. But that's where we are with this stock right now. So this next slide is a little harder for some people to follow. It's dividend safety in the context of cash flow. So just so you understand, and I've done a video on this, but cash flow is simply a measure of the money that comes in and the money that goes out. Where did it come in from and where did it go out to? We're looking at cash flow from operating activities. So I don't really care if you board money. I don't care if you have sold a division that's thrown a bunch of cash into your business. I'm looking at cash flow from operating activities. So what your primary focus of business is, how much money is that generating? So in this case, you've seen the cash flow of the company's done great. It's gone from $2 in 2015 to $13.75 in 2019. The cash flow from operations has performed very, very well. Capital expenditures have been extremely good. They've really dropped dramatically and are close to zero now. So this company doesn't need a lot of cash to maintain its operations. So that tells me the free cash flow for the business. Next, we look at the dividends that are paid. And in 2015, they had $2 in cash flow from activities, and they paid $6 in dividends. That's not sustainable, right? But if you look at how it's gone forward over the years, last year they had $13.75 in cash flow from operating activities, virtually zero in capital expenditures, which probably isn't sustainable. Probably they're going to need some, larger number of capital expenditures going forward. So that gives us a free cash flow of $13.75. We paid $7.72 per share in dividends. So cash flow to pay dividends is 56%. So that's fine. I'm happy with 56%. And the last 2 years, it's been 64% and 56%. So again, reasonably good. The average payout for the last 5 years has been 124%. But that again is really made overly large because of the gigantic amount they paid out in 2015 and even the large amount in 2016. It seems the trend's going in the right way. So I don't love this company's dividend safety relative to cash flow, only because 2 or 3 years ago it was so extreme. But I'm not that nervous about it because I see what's happening in the business otherwise, and I see the company's operations are ramping up and getting better and better over the last 5 years. So I'm okay with it, but I don't love it. Dividend safety in the context of debt. What I'm looking at here is if interest rates were to rise, at what level of interest rates do the interest rates gobble up all of my dividend money? So the company's paying all the money to the bank instead of paying all the money to me. And the idea behind that is interest rates are extraordinarily low. They're likely to only be able to go one way, which is up. And as they go up, you may be unlikely to pay off your debt and you may be stuck refinancing it at that rate. That's sort of the logic here. It really doesn't matter. The company has virtually no debt. And so even if interest rates were to go to, 20%, that would cause a reduction in cash flow of $2 a share, which gives them an adjusted cash flow of $11 a share. After paying dividends, they still have plenty of money left. So even in the most extreme interest rate imaginable, this company has so little debt that it wouldn't affect their ability to pay dividends. So that's it. That's a quick look at the company's debt and finances and balance sheet, which are all very, very strong. A look at the company's dividends, which are have a reasonable payout ratio, pay a 3% yield, which is twice the yield of the S&P 500. It's growing at 6%, which is a multiple of the rate of inflation. The company has very little debt, which will impact it, and its cash flow is strong enough that it should have no trouble supporting its dividend. So I like this company for the balance sheet a lot, and I love this company as a dividend payer for those of you who want to look at the company for a long-term hold as part of your retirement account. So long story short, all systems go with Value Line. Thank you very much for watching.